start out with things to avoid after applying for your mortgage. You know, because I've seen people make some big boo-boos after they apply for the mortgage. Like number one, the number one biggest one is don't deposit large sums of cash.
In your bank account?
In your bank account.
Why not?
Because lenders need to source your money, and cash really isn't traceable. So before you deposit any large amount of monies into your account, discuss the proper way to document your transaction with your lender, okay? So in other words, if your uncle is going to give you $5,000 to help you buy a house, and he gives you cash, just don't deposit it into your account. There's a correct process and procedure to do that so that money is properly sourced and it can be counted.
Okay.
Otherwise, they won't be able to use that money in the home buying process if it's not properly sourced. Another big one is don't make any large purchases. My best story on large purchases was a gentleman that they were in the process of buying their house.
Right.
They were maybe about 2.5, 3 weeks away from closing, and his wife's car completely just blew up. And so he said, well, I got to go get my wife a new car. I got to go, I got to go get her a new car. Got to do it. I said, look, man, give her your car, and you stop alongside the road where you see one of these places where cars.
Yeah, buy here, pay here.
No, not even that right there. You know how somebody just got a car out by the side of the road?
Yes, sir.
With a for sale sign on it. I said, that's what you need. And he said, no, I need to go in. I said, look, if you do that, you're going to ruin your loan. I say, just bear with me for a minute. Let me explain something to you. I say, if you're going to go out and buy a car and it's going to cost you $400 a month, I say, if you find a car for $1,000 alongside the road and you drive that car for 3 months, and that car just only lasts you 3 months and die, are you ahead of the game or behind the game? He said, well, I guess I'd be ahead of the game because I only paid $1,000 for the car, and if I had got a new one, it was going to be $400 a month. That's $1,000 versus $1,200. I guess I'd be ahead. So he said, okay. He bought a Jeep. Glenn, I ran into that guy a year later. He said, man, it won't die. It won't die. So he took the car he had given his wife. She traded that in and got her a newer car. He's still driving the Jeep. I saw him 2 years later. He's still driving the Jeep. Another thing, so don't deposit large sums of money. Don't make any large purchases. Like cars or furniture or.
What about appliances for the house?
Don't go out and do that. Hold off on all of that right there. No diamond rings. No.
We get in the house. We celebrating.
You need to wait until after you get the keys. Okay? Once you got the keys, you can make. Don't co-sign loans for anyone. We've talked about this numerous times over the years, Glenn, and you know how important it is. People want to help people, but when you co-sign, if you sign it as yours, that's the way I define co-sign. If you sign it, it's yours. In other words, you might be depending on somebody else to make that payment, but it's your payment.
That's the way it goes.
And that's the way it goes. So when you read that fine print in there, it's telling you, this is your payment.
That's what it means by co-sign.
Co-sign. And when the lender sees that you've co-signed for it, the underwriter is going to take that amount and they're going to calculate it into your monthly payment. And sometimes it can just ruin your numbers right away. Like
that don't seem fair though, Harry.
But hey, you co-sign. You sign. See, people don't realize that like a $600 car payment is $100,000 worth of purchasing power when it comes to a house. A $600 car payment is $100,000 worth of purchasing power when it comes to a house. So let's say you only qualify for $300,000, but you just went out and bought a car with a $600 payment. If you hadn't bought that car, you would have qualified for $400,000. Okay? So you don't want to make those big purchases. Don't switch bank accounts. in the midst of it. Lenders need to source your money and track your assets. It's much easier when it's consistency among your accounts. So before you transfer any money, speak with your loan officer. Don't apply for new credit. You know, it doesn't matter whether it's a new credit card or a new car or whether you have a credit report run by organizations in multiple financial channels. Don't do it because it can have an impact on your FICO score. It can drop your score down. Let's say, for instance, you're using Hometown Heroes and it requires a minimum credit score of 640. So you got a 642 middle score. And then you get this offer for this credit card. You don't read the small print. It tells you they're going to pull your credit. You fill out the paperwork, send it in to get this credit card. Even though it says 0% interest, they're going to hit your credit. Your credit score drops from 642 to 638. You no longer qualify for the program.
They'll kick you out?
No, they don't kick you out. They're just not going to give you the money. They're not going to give you the money. Don't close any accounts. That's like I tell people. Be wary about closing accounts because, see, 35% of your credit score is built on you paying everything on time. Okay? 35% of it is based on you paying everything on time.
That's good.
30% of it is based on how you use your credit card, okay? Whether you're using it properly or whether you're abusing it. That's when you hear us talking about the 30% rule. You know, never use more than 30% of the limit. Okay, on the credit card.
That's what you mean by how?
Yeah, you want to keep that down.
Not how many times you use it.
No, but you want to keep it below 30%. You know, you've heard me talk about the white paper method where you put things that you normally put on there anyway and pay that off every pay period. You're keeping it below 30% and you're manipulating the algorithm to increase your scores. But the reason why you don't close an account because 15% of your score is based on the term how old your accounts are. 15% is based on how old your accounts are.
How long you've kept the account.
Right. So let's say, for instance, you had a car and you did the 6-year plan on the car, okay? And you said, well, I only got about 7 months left. I'm gonna pay it off. No, don't pay that off. Let that stay there. That's helping your credit score up. Or you got a credit card that, well, I ain't used this credit card right here in 2 years. I'm going to go ahead, even though I done had it for 10 years, I'm going to go ahead and close it out. I got credit cards in my drawer that I have never even used. But you think I'm going to close them out? They're no fee. They don't charge me anything. And they're just sitting in my drawer. I don't even use them. But I don't close them out. Why? Because of the 15%. I want that bump on my credit score. Okay. Mm-hmm. And the final one right there when it comes to that right there of things to avoid is to make sure you discuss changes with your lender. You know, you're thinking about changing job. Discuss that. Changing cars. Discuss that. You know, changing where I'm renting at. Discuss that.
Oh, be open with it.
Be open with it. Discuss those things with the lender because your lender is just like a good lawyer. The more truth he know, the better he can help you.
Yes, sir. When
you withholding stuff from him, he can't help you. Why? Because you aren't being upfront with him to know what the real situation is.
That's good.
So those are some of the things that you want to avoid when it comes to applying for a mortgage.